Right now, before the opening bell, SPY's zero-day options are quietly printing a number, not a price target, a range. If the at-the-money call and put together cost about $4 with SPY near 500, the market is telling you it expects roughly a $4 move by the close, up or down. That single number is the most honest forecast in the market, and most traders read it completely backwards. Quick note before we start. This is educational commentary, not personalized financial advice. Any trade I mention is an example of a process, not a call for you to copy. Today we fix one misconception that quietly drains zero DTE accounts. Here's why this matters more than it used to. 0 days to expiration options, 0 DTE, now make up around half of all SPY option volume on a typical session, as of 2024. Half. A decade ago they barely existed. That means the single most traded contract in the S&P is one that expires in hours, where every dollar of premium is almost pure expected move and time decay. If you don't know how to read what that premium is saying, you're trading the most crowded instrument in the market blind. Start with the simplest case. SPY is at 500. You buy the 500 call and the 500 put that both expire today. Say they cost $2 each, $4 total. That's the straddle. You make money only if SPY finishes more than $4 away from 500 in either direction, above 504 or below 496. So the market is quoting you a fair bet on a roughly $4 swing. Divide by the price. That's about a 0.8% expected move for the day. The straddle price in dollars is basically the day's expected range. Here's the line to remember. The straddle isn't a forecast of where price is going, it's the toll for crossing the day. It says nothing about direction, it's perfectly symmetric. A $4 straddle doesn't mean the market is bullish or bearish. It means the crowd with real money on the line is betting the day's move lands near $4. The mistake is hearing expected move and thinking expected direction. Those are different words for a reason. Now the first way traders misread it. They see a small straddle, say the expected move is only 0.5%, and think cheap, low risk, easy. But cheap premium means the market already expects a quiet day. You're not being handed a bargain. You're being told the odds are calm and you're paying for calm. Cheap options are cheap because nothing is expected to happen. There is no free lunch hiding in a low number. The second, more dangerous misread. Most days the market barely moves, so I'll just sell the straddle and collect premium. It feels like free money. Sell $4, watch it decay, keep it, but look at the payoff. On a quiet day, you pocket maybe $4. On one ugly day, a surprise headline, a hot inflation print, SPY moves 2%, $10, and you lose 6, 8, 10 times what you collected. You win small often. You lose big rarely. The average is close to zero before costs. Now there is a real edge in there, and it's worth naming precisely so you don't overrate it. Implied volatility tends to run slightly above realized volatility. The move priced in is usually a touch bigger than the move that shows up. That gap is the variance risk premium, and it's why option sellers can win over time. But it's thin, and it's paid for with fat tails. You're picking up nickels that are real until the day the steamroller arrives and takes a month of nickels in an hour. So what should you actually watch? The straddle reprices around information. On a normal Tuesday, the 0 DTE expected move might be 0.5%. On a CPI morning or an FOMC afternoon, that same straddle can double or triple because the market knows a number is coming that can move everything. When the expected move balloons, it's not fear for its own sake, it's the market pricing a known catalyst. Reading that jump tells you how big a surprise is already baked in. There's a time dimension too. That premium doesn't bleed evenly through the day. A 0 DTE straddle bought at the open carries the whole session's move. By 2 p.m. there are only 2 hours left, so the expected move and the premium shrinks fast. That's theta. But the flip side is gamma. As expiration nears, the position gets violently sensitive to price. A small move late in the day can swing a near-expiry option from worthless to in the money in minutes. Late day 0 DTE is not the same trade as morning 0 DTE. So here's the mental model to carry to the screen. The straddle price is the market's honest estimate of the day's range, a toll, not a tip. You are never paid for being right about direction. You are paid when reality turns out calmer than the price implied, and you pay when reality turns out wilder. That's the whole game in one sentence. So what does a disciplined trader actually do with this? First, they read the 0 DTE straddle every morning as a range and size positions to that range, not to a dream. If the expected move is $3, a stop $2 away is inside the noise. You'll get chopped out. Second, they compare implied to what actually happens over many days instead of eyeballing one. Third, if they sell premium, they define the risk spreads, not naked straddles, so one bad print can't erase a quarter. The number is a tool for sizing, not a prediction to bet the account on. And this transfers well beyond SPY. Any liquid options market, QQQ, individual names into earnings, even index futures, prices and expected move the same way. Before every earnings report, the straddle is telling you the move the crowd expects. If you buy options into earnings and the stock moves exactly as expected, you can still lose because that move was already in the price. Once you see premium as a priced-in range, you stop being surprised by it moved and I still lost. So the next time you pull up SPY's 0 DTE chain, don't ask which way is it going. Ask what move is already priced, and is that cheap or expensive versus what I actually expect. That question alone puts you ahead of most of the people trading the most crowded contract in the market. If breakdowns like this are useful to you, subscribe. Paragon Signals is signal, not hype. Trade the process, respect the tail, and let the number do its job.